Good morning, everyone, from a cold and rainy Cape Town. Thank you for joining us for Nedgroup Investments Insights. Today, I'm joined by Omri Thomas, Portfolio Manager of the Nedgroup Investments Opportunity Fund. Omri, together with the team at Abax, has been managing the fund since its inception in June 2011. The Opportunity Fund is a Regulation 28 moderate risk balanced fund aiming to generate inflation-beating returns over the medium to long term while protecting against capital losses over rolling 24-month periods. One of Abax's strategic advantages in managing this mandate is their ability to invest beyond traditional asset classes to add value via a broad range of strategies. They seek to balance risk across the alpha sources and construct a well-diversified portfolio. This approach has seen the Opportunity Fund deliver an annualized return of 8.4% per annum since inception. And this is a pleasing result when compared to the peer group return of 7.7% per annum over this period, with the fund participating in almost 90% of the equity market's return as measured by the FTSE JSE All Share, but with a maximum equity exposure of 60% at any given time. At this point, I'm going to hand over to Omri. As we go through the presentation, please feel free to submit any questions you may have through the meeting chat portal on the right-hand side of your screen, and we'll try to go through as many as possible with this, of these with Omri after the presentation. A recording of the presentation will also be available subsequent to this session. Omri, over to you.
Good morning. Thanks a lot, Moini. Guys, what I'd like to do today is just give you a quick update on the performance and then just give you a view on where we see the markets at the moment and how we position for those markets. So without further ado, if we look at the last 3 months, the fund had a really good quarter. As you recall, the first quarter was quite tough, and a lot of those positions that hurt the fund during the first quarter actually came back nicely. We still think there's substantial upside in quite a few of our positions, and I will refer to some of them later. But what really helped this quarter was a good recovery in CCIL. So we retained our position in CCIL. In fact, we added a few CCILs at the lows. Our exposure to the Abax Global Equity Fund really contributed both on two fronts, the rand depreciating as well as quite good stock picks within the Abax Global Equity. So we had exposure to the names of Amazon, and we've seen how well Amazon has done. I'll show you just a slide on that a bit later. And then similar to that, Naspers having a fantastic quarter with Tencent hitting new highs. So quite pleasing 3 months, and hopefully the performance can continue. So if we look at the macro outlook at the moment, we've seen a very strong equity market recovery, and that's in the face of a weak global GDP. We're probably facing one of the worst economic crises in the last 100 years, and yet markets are close to all-time highs. That's been supported by very aggressive monetary easing, unprecedented record monetary easing, and I'll show you some graphs on that. So for us, the concern is that COVID-19, it doesn't look like it's peaked yet. It looks like it's picking up in the US again, but everyone's talking about the second wave. For us, the concern about a second wave is not a second wave of, let's call it a medical second wave or a pandemic second wave. It's an economic second wave where the full impact of the economic hit is felt by companies as they report their income statements and balance sheets. So we've continued to see the COVID-19 beneficiaries rallying, and those valuations are getting to extreme levels where it's now driven by momentum rather than fundamentals. South Africa has also been a beneficiary of the easy money despite the poor fundamentals, and we're seeing it reflected in both our equity market and our rand. Again, I'll just show you that. So if we look at the S&P, we can see the sell-off that happened in March and the recovery that's followed, almost back to the sort of pre-COVID highs achieved in Feb. And if you take a bit of a longer-term graph, I mean, it was a blip down, and we're almost back there. Now, what's supported that? As I said, unprecedented monetary easing on the left-hand side. It's the Fed's balance sheet. You've seen that the Fed's balance sheet has grown from about $400 million before the global financial crisis in 2008 to, and for the next 10 years, that balance sheet expanded from about $400 million to about $4 billion. So it grew by tenfold, but over 10 years, 12 years. The expectations is that that balance sheet is going to grow to 12 trillion US dollars by end of 2021. I mean, so it's more than double what it was prior to COVID. So it just shows you how extreme it is. And on the right hand side, you can see the ECB, similar strong growth in the monetary base. Now, what's further been supporting the market into the COVID crisis in March, you actually saw a lot of short selling. So this is a graph detailing the amount of shares that have been borrowed to sell short. And you can see how that spiked in March. And now, more recently, those short investors have had to buy back those shares at higher prices. And that's been giving further support to the market. In addition to that, you've seen the growth of very low cost or no cost trading platforms where retail investors have started aggressively investing in the markets. So the US example of that is a company called Robinhood. And in South Africa, there's a great low-cost trading platform called Easy Equities. And both those platforms have invited a lot of retail and new investors to the market. Now, what effect has that had? This is a graph of the Tesla share price in pink and the amount of Robinhood holders in Tesla in green. And you can just see the extent of growth since March coinciding with a very strong return from Tesla. Now, the current price of Tesla, that values the company at about $600,000 per car manufactured last year. Now, to put it into perspective, if they're lucky, they probably make about $5,000 profit per car. So that's valuing it at multiples of what profit they make per car. We think a lot of it is being chased by hot money. I mean, similarly, Amazon, you can see in green again the Robinhood users coinciding with the growth in the share price, coinciding with their increased holding. And I mean, Amazon has basically doubled from its lows in March. So not really looking particularly cheap at this point in time, but huge demand for the stocks. A South African beneficiary has been CCIL. There's a CCIL ADR listed in the US, and you can see also into the lows. We've seen quite a lot of buying in CCIL, and more recently a bit of selling, again coinciding with the weakness that we've seen in CCIL. And our market, the all share, has also been benefiting because of this easy money. A lot of the money flowing into South Africa. Admittedly, it's been more our resource stocks and our diversified industrials or dual-listed stocks like a Naspers that's been driving the market. A lot of our local domestic-facing stocks is still at quite low levels. The Rand also being a beneficiary. This is a graph as at March. When we did our last presentation for the first quarter, we said the Rand looked extremely oversold, and you can see it was trading at more than 10% below what we saw as the fair value, comparing to other emerging market and commodity currencies. And from there, we've seen a strong rally in the Rand to actually be slightly overvalued at this point in time. Now, if you take into account that our fundamentals are very poor, and you adjust it for our poor fundamentals, we would see it's not only slightly overvalued, but probably quite a bit overvalued. So over the medium term, we remain concerned about the currency. We think we'll have to keep interest rates relatively high to attract money. Despite us cutting rates, our real rates are still high relative to the rest of the world, which will put pressure on GDP growth, but will have to be kept there to continue to support capital inflows. So if we look at the fair values of the different asset classes, we see SA equity still reasonably attractive. SA bonds on a relative basis compared to the rest of the world's bonds attractive, but on an absolute basis, we think it's closer to fair to expensive. So we have been reducing our bond duration, quite a short bond exposure at this point in time. We think SA property is attractive. We have been increasing our property exposure into the sell-off. We still think hybrids are attractive, so convertible bonds, specifically the Royal Bafokeng convertible bond, which is getting close to that price, the strike price, where we start participating in the upside. SA cash, again, on a relative basis, quite attractive levels, even though the nominal rates are a lot lower. And then emerging market equities, similar to South Africa, we still see some value in some of the markets. We think in the fair bucket, developed market equities outside the US, we think the US is looking expensive. Commodities also looking fair to almost moving to expensive. And then anything credit related, offshore, looking expensive, whether it's bonds, credit, cash, and then US equities also looking expensive. And then the rand, as I said. So from an asset allocation position, our equities is now at 42%, which is slightly lower than when we last reported. And then you must take into account that the market has also rallied. So taking that into account, we've actually reduced our equities quite a bit. We still think on a medium to longer term view, you have to have a substantial allocation to equities because all this easy money in the world at some point in time is going to become inflationary. So you want to hedge against the inflation risks. And equities is a good way to hedge against that. Our bonds at just under 8%, very short duration on the SA government bonds, and we've also introduced inflation linker bonds, again to protect against inflation. Property I've spoken about, convertible bonds I've spoken about. Maybe just on our offshore equity, half of that is to the Euro stocks notes, where we've got, that actually hurt us in the first quarter because the Euro stocks market dropped significantly in a very short space of time. And all that accrued value we had on our Euro stocks notes actually returned back to our capital guarantee levels. Now, where we are now, our downside is quite limited given that capital guarantee that's there now. But if there's a further rally in the European market, we can see quite nice participation in that. So on our offshore portfolio, half our exposure to the investment notes, where we've got the capital guarantee, and then the other half to basically the Abax Global Equity Fund. But we've also got 2 hedges on the S&P to protect against a global equity sell-off. Our top equity positions are Naspers, where we've basically almost hedged our full exposure at this point in time because it's rallying so hard. We think there's been a lot of momentum, and if there's a much stronger rally in Naspers, we won't participate in that much of that rally. However, similar on the way down, as Naspers sells off, we won't participate in a big part of that sell-off. Our second bigger position is PSEG, which we've increased over the last quarter. Still think there's some value to be unlocked there. CCIL, we have sold at the high levels, but that's now about just over 3% position in the fund. And then local banks, we retain quite a big holding. Despite our concerns about the domestic market and the domestic economy, we still think the banks offer value and discount a very dire situation already. So just to conclude our portfolio positioning, we've got reasonable exposure to real assets. As I said, we do expect inflation risk. We've increased our gold exposure, within equities also to compensate for that. The inflation-linked bonds we think will help. In the last week, we've introduced 2 hedges on the local market as well to further protect us if there is a sell-off in the SA market. And we've got quite a substantial bucket to yield alternatives where we can get a return that is higher than what we can get in cash markets, almost an equity-like return, but with a lot lower risk. As I said, our Eurostoxx basket very attractively priced, and we're also running with slightly higher cash levels than normal to try and take advantage of any sell-off that we could see in the market. I think with that, I'll conclude and open it up with for any questions that there may be.
Mohini, please unmute yourself.
Sorry about that. Omri, we've got some great questions coming through. The first one, can you give us an example of the yield alternatives in the fund that you have instead of the local bonds where you're running a very low duration position?
Yeah, so I think one of the yield alternatives would be, as an example, Atlantic Leaf Property. So Atlantic Leaf Property got a buyout offer from a UK private equity grouping, and that buyout offer is about 5% above the current share price. Now that payoff will happen only or in about 2 months' time. So the annualized return on that, on a yield basis, is very attractive. So that would be one example. The PSEG preference share remains a very attractive yield alternative, about an 8.5%, and that's a dividend. So on an after-tax basis, a very attractive return. And then we've also got some higher quality property companies that's higher up in the capital structure that even though we think distributions in the short term will be under pressure, we do see under normalized distributions very attractive returns and yields from that.
Great, thank you. So just a follow-up question there, you spoke about PSEG as being one of your yield alternatives, and you've also shown it as one of your largest positions equity holdings. Now, given the recent announcement by PSEG on the Capitec unbundling, how do you think this is likely to impact that position? And has the value in that not already unlocked?
That's a good question, Mo. I mean, we have seen a substantial unlock in value in PSEG, but if you take out the Capitec shares that get distributed, and you take that out of the share price, and you look at the remaining value that's within PSEG, and where this share price will be trading at, we still almost see close to a 40% discount to net asset value, and it's quite a hard net asset value because it's listed assets. 1, 2, there's some cash within the group, and also the portfolio of shares that remains within the group is trading at substantially lower levels compared to historic highs. So you're buying a good quality basket of stocks way below historic highs, and then you're getting that at quite a deep discount. So we still see PSEG as an attractive position. We've got just over 4% in the fund. We've got a hedge over a small part of it, but we think it's quite attractive.
Thank you. There are quite a few questions coming through on Sasol. Do you have any concerns around this position? First quarter, it was obviously one of the larger detractors, but we saw quite a significant recovery in the second quarter. How do you feel around this position, given that the oil prices have recovered somewhat? Has there been any additional information that's come out in the last few months which has impacted your view and the investment case?
Okay, that's a great question. So I think the investment outlook is a bit more balanced now than where it was in March. Obviously, in March it was extremely oversold. The market was very concerned about the oil price, about the ability to generate profits at that lower oil price level, and the ability to refinance their debt. So new management got introduced to Sasol the second half of last year, and I must say I've been really impressed by new management. And again, in this crisis, they've very quickly acted. So they've indicated 4 ways to address the market concerns. One is they have negotiated a $2 billion standby rights issue, a fully underwritten rights issue. Now, our concern was that they'll do the rights issue at the wrong point in time and do it at low share price levels, which they haven't done. So we're quite pleased with that. The second thing is they were going to look at cost-cutting measures. So they've done that as well. So they've significantly reduced costs. They've decreased the planned capex and cut it to the true critical capex that needs to be spent. And then they've also announced that they'll be looking at selling some of their non-core assets. Now, we haven't seen major sales yet, but there are. It takes time for that to happen, and you also don't want to sell assets at a fire sale level. And then lastly, they've indicated that look at strategic partners at some of their major assets. And the biggest one that's been a drag on the debt on the balance sheet has been Lake Charles, and they're probably looking to sell or to partner on about 35% of Lake Charles. And the rumored valuation is about a $2 billion valuation. Now, which values Lake Charles at $6 billion for the total asset, which is not far off the total market cap for Sasol. So if they do achieve that sale at that rumored valuation, we think it will be very positive for Sasol, and it basically puts the rest of the business on close to a zero valuation. So as I said, we have reduced our Sasol position at the high levels tactically, but we do still see medium-term upside in Sasol. We also think that longer term, the oil price is not sustainable at these levels, because more than half of global oil producers are actually loss-making at the current oil price. Now, that won't recover quickly because there's not enough demand. But as demand starts recovering, the oil price will have to follow. And Sasol is in a good position that they're in the bottom half. Their cost of production is below $35 a barrel, and with these new cost-cutting measures, probably even lower than that. So we think medium-term Sasol continues to look attractive, but as I said, after the strong rally that we've seen, a bit more of a balanced outlook there.
Thank you, Omri. You spoke about protection structures, particularly over the S&P 500 and the all share. Now, given the spike in volatility, the extreme volatility that we've experienced in the first quarter of this year, with markets plummeting something like 30% in the S&P 500, only to recover almost fully a couple of weeks later, what is the price of this protection, and how do you balance the need to preserve capital with the need to be exposed to risk assets to generate sufficient inflating beating returns?
It's a great question. And it's one that we battle with continuously, especially a mandate like this, where you try and achieve both, get a bit of upside participation, but also protected in the downside. And you're absolutely right, or the person who asked the question, during that sell-off in March, as volatility spiked, to buy protection at that point in time was extremely expensive, and it didn't make sense at all. But as we've seen the market recovering and rallying, volatility is actually reduced substantially. Now we're getting close to a level where we at or close to all-time highs, but volatility is now very low. So protection on the S&P, the cost has actually dropped substantially. So it's perverse, or it's almost the inverse than what you think is. If markets have sold off, then your protection at that point in time is very low. If markets rally, your protection is then quite attractive. And because of that, we have introduced a bit more protection. So the cost for the fund is not that high, because I mean, say as an example, just to put it in perspective. So say our offshore equity exposure to Abax global equity is 6%. So say we hedge half that, we hedge 3% of that exposure, and the cost of protection is we've probably paid about 2%. So 2% on 3%, that basically means at the fund level, your cost is 6 basis points. So given the comfort that gives you to have that protection, we think it's a fair cost to pay. What we do in South Africa, we do structure that we give away a bit of the upside so that we lower the cost. So we've done two structures where our cost of protection is about 1% of the amount of exposure that we hedge. So we've done two structures of about 1.5% each. So that's basically 1.5 basis point each for those two structures. Now, I mean, it's like having insurance. It comes at a cost, and you hope you never have to claim. But if you do claim, it's nice to know that you've got that protection. And then our NASPERS hedge has been going for a while. There's no further cost on the NASPERS hedge, other than the opportunity cost of missing out in further upside.
Great, thank you. That was a very comprehensive response. You've recently added a gold position in the portfolio. Now, while many consider this asset class to be a safe haven asset, critics of gold point to the fact that it doesn't pay a dividend, it doesn't pay a coupon. Over the long term, it hasn't kept pace with equity investments or sometimes even inflation. Why have you added gold at this time? Has it historically played a significant role in the portfolio? And if not, do you see that it will play a bigger role in the portfolio going forward?
So I think the criticisms against gold is spot on, and that's been our criticism as well. Now, I mean, so gold doesn't pay dividends. You don't earn income on gold. So the opportunity cost of owning gold is what you can actually earn not having gold. So you could have had it in cash or fixed income market, earning great returns historically. Where returns are now in terms of cash alternatives, your opportunity cost for having gold in your portfolio is very little. But the benefit of diversification, on having safe haven assets, on protecting against inflation, from this point in time is a very attractive return. In addition, in the South African context, it is 100%, in fact, more than 100% rand hedge, because a lot of your costs are rand-based and your income is all dollar-based. So we think at this point in time, having gold in a balanced fund makes sense. And it will play a more meaningful role going forward until we see it getting to ridiculous levels within the fund.
Thanks, Omri. There are quite a few questions coming through around your offshore exposure in the fund. Can you comment on what your current offshore exposure is and maybe touch on what your view on the currency is, South African currency relative to developed market currencies, and also how you view the relative attractiveness of the South African markets to the rest of the world, US, other emerging markets, other developed markets?
Okay, I think there are about 5 questions in that one. So maybe just start with a view on the currency. We think the currency looks reasonably or too strong at current levels. So a while back we thought the currency would look too weak. So we did put a hedge in place to protect the fund in case the rand would strengthen. So that has helped the fund. At current levels, we think the risk has swung to the opposite side. So we have been increasing our exposure to our offshore exposure. In total, if you look at our equity exposure, our foreign bond exposure, our foreign cash exposure, as well as currency futures that we've bought, we're sitting at about a 25% allocation to offshore assets. And if the rand strengthens further, we'll probably look to get our FX exposure closer to the 30% limit that we can go to. In terms of the SA attractiveness relative to other markets, we do still manage to find value in the local market. The risk is a bit that it's a value trap because we are getting closer to a crisis in terms of the pandemic. So the COVID is almost getting to a level where we're getting to Italy's levels. I think, well, probably in the next 2 or 3 days, we'll surpass the numbers of Italy. And I think that is a concern on the outlook for the domestic economy. So yeah, I think the SA market looking attractive. There could be a bit of short-term pain, but I think a lot of that is discounted in share prices. So yeah, I think that's probably all on the currency side.
Thank you. There's a question coming through on your property exposure and your resources exposure. You seem contrary to market sentiment at the moment, which has seen the listed property sector being one of the poorest performing sectors over the last year, which has also impacted on longer periods, and conversely, resources being one of the best performing sectors. What are your views on the relative attractiveness of these sectors? You have just over 6% position in listed property, but a correspondingly lower position in the resources sector. Can you give us some insights into this positioning, please?
Sure. So we have been reducing our resource exposure into the strong rand that we've seen. So I mean, we did have a bit of a higher position. We think at current levels, again, resources is a very volatile sector. Your forecast risk there is very high, and investors have made very good money from resources. So I think it's just prudent to have reduced our resource exposure, and it's in selective counters that we retain the resource exposure. In terms of property, it's the converse. I mean, property really got hammered as there were concerns about ability of tenants to pay rentals. And I think it was almost just a one brush for all, which also gave you opportunity to get exposure to some of the higher quality property companies or in the more protected part of the capital structure at attractive levels. Now, part of that property exposure is also the Atlantic Leaf property exposure, which is about 2.5% of the 6%, which we think is it's almost a yield alternative because there is a buyout offer on Atlantic Leaf. But I still think even at current levels, selectively, there's property companies that you can pick up at very decent normalized yields.
Thanks, Omri. It seems like there are even in these difficult and volatile times, it seems like you have quite a few arrows in your quiver to deliver on the fund's objectives of inflation beating returns over the longer term while protecting capital over meaningful periods. Are there any positions in the portfolio that you are very concerned about at the moment?
So I think the domestic exposed companies remain a risk, and for that reason, despite the attractiveness and looking like it's offering value, one probably would have liked to have more, but we've deliberately, because of that risk, kept it at a lower level from risk management perspective. And because we do see value, we've retained it, so we haven't completely sold out of it. But that is probably the one area that there is a bit of concern, and because of that, we've also sort of introduced those hedges on the local market. But we think the fund is from current levels well positioned to achieve the inflation +5 objective. We think we've got quite a few attractive assets within the portfolio, a lot of them with capital protection embedded, or if it's not embedded, we've added some of that. So we're quite positive about the future for the fund, despite our concerns about market levels at this point in time.
Okay, great. Thank you very much, Omri. Just one last quick question. We're coming to the end of our time. The last 6 months have been an emotional roller coaster with countries around the world in lockdown. We might be seeing a new normal in terms of people working from home, working remotely instead of in the office, traditional office environments. How have you and the team been navigating these difficult times, and how has it impacted on your focus, your ability to manage assets? What strategies can you maybe share with us? Have you implemented to stay focused and keep sane?
Yeah, it's a good question, Mo. So I think and I don't think I'm unique in that space. So initially, it felt almost. It was very exciting because it almost felt like a working holiday. You sat at home, it's a new environment. You could have with the family and then still work, and then when you finish work, you straight at home. But what I found is it's almost as if you work harder working from home than at the office. It's very focused. And there's no break between work and home, which is difficult to navigate. So I've purposely set a time for me every day where I then leave the office at home and close the door, just to divorce the two. You do miss the interaction with people. I'm very much a people's person, so I miss the interaction with my colleagues. We have a daily call, and I do go into the office once a week. But I think there's been so many positives and productive things that have come out of this as well. So, having a webinar like this, I think going forward, this is going to become a more regular feature where people don't have to drive to the Cape Town Convention Centre to listen to me carry on. They can sign into the webinar, and after 10 minutes of saying, no, this guy doesn't know what he's talking about, they can switch it off and continue with their work. So a lot more, much higher productivity. I think companies have found, and we've heard from CEOs that there's parts of their business that's the same productivity with people working from home. So the true cost of that productivity is a lot lower. The same productivity without having the office space. So we're going to see pressure on office space, and we're going to see more people working from home, which I think is a good thing. You're going to have less congestion on roads, and I think more productive workforce. Thanks very much.
On that note, Omri, thank you very much for joining. We appreciate your time today and just the spirit of the partnership that Nedgroup Investments and Abax share, your willingness to be available to address clients' queries and concerns and help them to navigate these difficult times. To our listeners, thank you very much for joining this morning. Don't forget the recording of the session will be available afterward. You can contact your business relationship manager if you would like a copy of this. And also just a reminder that later today, you will be hearing from Rashad Tayyab of Abax Investments. Rashad manages the Flexible Income Fund, and he also manages the fixed income component of the Opportunity portfolio. So please tune in later today at 2 o'clock, I think it is, to hear Rashad's views. And also next week, we'll be hearing from some of our global best of breed partners, as well as our core funds. Thank you very much to all for joining today and have a great weekend. This is Mohini Naidu for Nedgroup Investments.